Good evening, everyone. I think we're about ready to get started. I wanted to catch everybody up. Apparently, Alyssa and Derek and Quinny are home, so that's a good sign. So I would still appreciate any prayers and thoughts for that little one. So thank you so much for that. To get things going this evening, we had to pivot since Alyssa and Derek aren't here. They were the ones that were going to be up here talking to you. So now you have me. Thank you. Well, we're very excited to acknowledge that this week marks our 1-year anniversary of becoming an independent financial advisory firm. It's been a year of transition, developing new processes, and dedication to our growth. Our goal for this transition was to build a financial advisory practice that upholds our values and our commitments to you. We now have access to an even wider range of resources, giving us more tools and more efficiency, like faster investment transactions and more personalized education opportunities. With technology changing daily, we need to stay one step ahead and be willing to adjust when necessary. We made the decision to become independent to put our team in a better position to help you, not just for today, but for future generations. Ben dedicated 29 years to his previous broker-dealer, so making the decision to change was thoughtful and it was a significant step for us. I remember a story from the early days when business was challenging. Ben came home very distressed and asked me to only buy essentials because he didn't know where the next paycheck was coming from. All I can say is we've made a long, bumpy journey and we made our vision come true. When Ben moved the practice to our current location in 2006, I thought he was out of his mind, to be honest with you. We had this huge building and we only had a few people, and I thought, my Lord, how are we going to fill this building? The building was huge and we didn't have anything in it. So we repurposed furniture from our home to furnish the office at first. We brought in desks, we bought in chairs from our sunroom to sit in our lobby, and our family's kitchen table was Ben's desk for several months. Coincidentally, those items are now in Alyssa and Derek's home. 18 years later, it's amazing to think how sparse the office was when we started out and how full it is now and almost fully decorated. So today, Ben is a shining example of dedication and success. Over the past 30 years, he's achieved remarkable milestones, including being inducted into the Hall of Fame by our previous broker-dealer, which is the highest honor that was bestowed, earning multiple 5-star wealth manager accolades from Cincinnati Magazine, making the Forbes Best in State Wealth Management Teams list. That's thanks to our whole team. Teaching continuing education and programs to attorneys, CPAs, and even financial advisors through the Financial Planning Association. He was recently inducted as a board member of the American Heart Association, and he previously served on the board for the Institute of Divorce Financial Analysts, and I'm going to add Alyssa's on that board currently. Our family and Feldmeyer Financial Group are committed to philanthropy. We've supported numerous causes, including Crayons to Classrooms, Dayton Children's Hospital, where Alyssa and Derek were today, the Food Bank of Dayton, the Alzheimer's Association, Parkinson's Support and Wellness, the American Heart Association, and the Umberfirth House, which is housing families at Ohio State's Ross Heart Hospital. These efforts are close to our hearts, particularly supporting children's charities and causes tied to health issues that have impacted our lives and some of our clients' lives. I feel very blessed to have witnessed the birth and the rise of this company. I'm grateful for the opportunity to work alongside Ben and my kids and support causes that matter deeply to us. It's my pleasure to introduce my partner in life, Ben Feldmeyer.
Gretch. Good evening, everybody. Can everybody hear me okay? All right, good. Okay. If you've heard me speak before, yeah, everybody's been around me, right? You know, I don't read scripts because it's not my personality. But if you were at our pool party earlier this year, you'll know why I have to write everything down, because I was introducing our whole team, got through everybody, and was like, okay, and I realized I had not mentioned Alyssa and Derek. Okay, note to self, write stuff down, right? So thank you, Gretchen, and if I say Alyssa, it's because that's what's written down in front of me. I want to thank everybody for coming out tonight. I know that everybody in this room is busy. Gretchen and I shake our heads. I was speaking to some of you here tonight about how busy our lives are. And it seems like, how could we be so busy? And then I hear all the things that we're involved with. I look at all the things that we're doing. And she and I look at each other over dinner at 8 o'clock at night and say, I know why we're busy. As I prepared for tonight, I took a minute to look back over the last year, and I found some things that I wanted to be sure to share with everybody, some milestones that have occurred over the last 12 months. I'm going to move through these pretty quickly. 30 years for me being in business. Derek has been with us for 10 years. Gretchen's been with us for 10 years. Alyssa's in her 6th year as an advisor, but she worked for me when she was in high school. And if you've been around me and you've been around her, you know she's me. Right, she's me, just a completely different rapper. Don's up here laughing. Yes, she is, right? She's smarter and prettier than I am, but that doesn't really take much at this stage of the game. This is the 40th year from the first day that I met Gretchen, and 35 years that we've been married. She and I both turned 60 this year, and are very happy and very thankful for every day that we've had together. Gretchen talked about our enhanced technological capabilities and that have come up from becoming independent. And here's some other things that I wanted to share with you that we've done over the past 12 months to get more information to you faster. The first of which is our website is written by us, not by some big company that says, put this stuff on your website. It's our message. And if you read it, you'll say, I can tell who wrote this. And it's like you're sitting there talking with one of us, because we did write it. We're now able to record our webinars and send out a link to you so you don't have to listen to it live to be able to hear what our message is. We couldn't do that before. It's very important to us. We produce 8 newsletters a year. That's about every 6 weeks. 4 of those newsletters are our Feldmeyer forecast, where we actually get into the weeds on what's going on. And if you've tuned in or if you watched any of them, you know this is where we start going through the charts and graphs and explaining what we're doing with our strategic models. The other 4 focus on an advisor or someone in the office so that you get to know them a little bit better. Each newsletter also has an around the office section with information so that you can know what's going on with us. And it might be our favorite donut, it might be our favorite band, it might be whatever. But I believe that this is a personal business, and we get to know you, and we want you to know all of us, right? Because when you call in, you want to be able to say, oh, I know John, I know Becky, I've met them, right? I've talked with them. Another change that's come in the last 12 months is that our investment partners, like the folks who were here earlier, you probably saw me speaking with them, the companies that they represent are on the table and up on the buffet. They've come to us and said, okay, now that you are not where you were, we've got some really cool stuff that we can share with you that you didn't have access to before. That's another reason that we made the change. We have discretion over the investments so we can run the models, and that leads to efficiency, because I don't have to call somebody at 9:30 in the morning and say, I know that we just talked about this last night, but the market closed and I have to get new permission to be able to do this because it's another business day. Anybody ever get one of those calls from us? Yeah, a couple of hands go up back there. Yeah, we don't have to do that anymore because it's a nuisance to you and it's a nuisance to us. All of these things come along for the ride, but the most important thing is something that we have always been, but it was not drawn in the sand that this is what we are, and that is that we're a fiduciary to you. I don't understand how someone can work in my role and not be a fiduciary to their clients. And by the way, if you're not familiar with what that means, it means I have to put, we as a team, have to put your best interest first. How do you do this if you're not putting the client's best interest first? Well, as I shared with some folks just a little bit ago, my industry's full of people who are financial product salespeople. They're just selling whatever it is that they've got to sell, whether you need it or not, right? That's what I have to sell, so that's what I'm going to recommend that you should have, okay? That's not what we do. We're going to find what you need. We're going to get a solution to things. With the transition, we had 98% of our clients come with us. The industry average is 70%. If you were in the office when that was going on, y'all came in waves. It was like, okay, all right, everybody's gone. Catch your breath. And we look out and 5 cars would just pull in. Some folks, we said, it could be an hour, maybe 2 before we can get to you. And they said, that's okay, I'll wait. We could not do what we do, and we could not have gotten where we are today without you. Your loyalty, your friendship, your trust in us is the most important thing, okay? My team was also very dedicated on this. We actually came up with something, I think it was to keep Becky from losing her mind, that we called the quiet room. Yes, you did. Oh man, it was so nice. It's one of the spare offices down the hall, and if you say, I need 2 hours in the quiet room, what that means is, leave me alone. I don't have to answer the phone, I don't have to check emails, I don't have to do anything. I have to have a couple of hours to be able to get through this work. And you know what the rest of the team said? Sounds good, I could use an hour tomorrow, right? We work together to make the system as best as we can. And we built in some specialties in everybody's work. Let me explain what I mean. All of us, Derek, Alyssa, and I all do traditional comprehensive financial planning to help all of our clients with all the things that come along, but specialty work. Derek works in the small business advice market and exit planning for small business owners. We all do regular stuff, but if I talk to a business owner, I'm going to say, you really need to talk to Derek. He's our expert on 401ks and retirement plans and all those different types of things. Alyssa specializes in what? Women's stuff, right? She also leads our company called Alternative Divorce Solutions. By the way, Alyssa and Derek, I think everybody's putting together, have 3 kids now. They had another baby this year, right? And just to keep things interesting, decided to move from the north side of Centerville to the south side of Centerville this summer because we didn't have enough going on, right? And their house is under construction, so they literally have jumped into the deep end. Bless their hearts, and now they got a sick kid. Gretchen, of course, her work is specializing in things like this. And guys, if anybody thinks I had anything to do with anything that you are a part of tonight, you're wrong. I don't have anything to do with it, okay? Everybody knows that, right? Can I hear it for Gretchen? Right? Becky handles the calendars, our insurance work, all estate settlements. Steve handles all the mathematics and all of our trade executions on our investments. John, who we have dubbed the most patient man in the entire office because he runs our financial planning department. And John's back over there, right? Becky's right here, right? Steve, where are you hiding? Steve's right here. Gio's someplace. Where's Gio? There's Gio. Gio's the newest member of the team. So why, Ben? Why do you have to have all these people? Why do you need to do this? The reason is that we built a team this big and this dynamic because our mission is to create a practice that serves you and your family with excellence for generations. It's not just about me or us or something like that. It's about you. And it's not just about you in the short term. It's about you, period. You and your family, everything that we're trying to get accomplished. This has also been a year of growth for us. Our primary source of growth has been referrals from you. We believe that there is no higher compliment that you can give us than to make an introduction to a friend or a family member. And we're actually having more and more what I call second generation clients. Everybody get what that means, right? It means your kids are coming to see us. Or maybe even you're introducing us to your parents and saying, we need help as a family with these things. Cool? Everybody with me? All right, because I'm going to completely change subjects now. All right, thank you all for everything. Enough of that. Let's get down to business. In front of you is a folder. Please open your folder. On the right-hand side, there's a piece that looks like this thing that's up on the board. Please pull that out. I'm going to give you just a second to take a look at it. Everybody with me? Okay. Earlier, Gretchen said that we have added efficiencies, and I talked about it too. Those efficiencies allow us to spend time in our meetings talking with you about the things that are on that page. What we heard from you is, I don't care about the yield curve, Ben. Okay? Do we have to spend all these meetings looking at charts and graphs and things? Because what I really want to talk about is the stuff that's on this page. I want to talk about my kids. I want to talk about my next vacation. I want to talk about the house remodel. I want to talk about these types of things. I need you to understand the yield curve and handle it. Okay? We call these lifestyle goals. These are the things that are going to be our emphasis to talk to you about when we see you from here forward. But don't get me wrong, if you really want to talk about the yield curve, we will, right? We'll have everything ready to go, but it's, Jeff's going, no. The idea is let's take the technical part off the table and let's talk about what you really want to talk about. We're listening. So when we see each other, these are the things that we want to have as our topics to talk about. But tonight, we actually are here to talk about things like the yield curve and the markets and the economy. So let's get to our keynote speaker. Matthew Miskin is co-chief investment strategist with John Hancock Investments. They are a nationally recognized, very prestigious firm. Matt has over 15 years of industry experience, and prior to joining the company's investment division in 2014, he was a due diligence analyst at LPL Financial Research, where he was responsible for the asset allocation changes relative to the firm's recommendations list and discretionary models. That is one sentence. That is an impressive bunch of stuff there. Matt has a Bachelor of Science in Finance from Elon University and an MBA from Babson College, and he holds the Chartered Financial Analyst designation. With all of that done and all of that said, please, everybody, help me welcome our keynote speaker tonight, Mr. Matthew Miskin.
Thanks, Ben. Appreciate it. So y'all want to talk about the yield curve? No? Wow. What an intro. And, you know, I want to be a client now of Feldmeyer Group. So I'm pretty jealous of you all. So a little background about myself. I have a family at home just outside of Boston. I have 2 daughters, 8 and 11. Got a couple friends in the neighborhood, but other than that, this is pretty much my life. I talk about the yield curve a lot. I talk about corporate earnings. I talk about the market outlook. So I represent John Hancock Investment Management. This is our market outlook. I'm going to just go through some select slides with you that I really think are important to think about as an investor and just about the economy in general. We want to have this be discussion. So I would love to have questions. We're going to probably wait to the end so that we have a microphone for you all. But let's get right into it. So, if there was one thing that really matters in terms of investing in stocks, it's called profits. In our view, stocks follow profits. We're going to talk about the election. Did you all know it's an election year? No? Okay, good. We're going to talk a little bit about that, but we're going to tell you that this actually matters more. And this is actually a chart of corporate profits and that's in the blue, and in green is stock prices. Corporate profits are at all-time highs. Now, working with the Feldmeier Group, you're lucky because they've actually been finding companies that have been growing earnings and growing corporate profits over time. It's been actually some of their best investments, technology companies in particular. But if you're an investor in the stock market, it doesn't matter about politics. It doesn't necessarily matter about the economy, oddly enough. The stock market's different than the economy. What matters is if corporate profits are growing. And right now, they're up about 11% on a year-over-year basis. They're rising to all-time highs. And to us, that is one of the key reasons that we are overweight US equities. We actually see the US economy as the strongest economy in the world right now. In fact, this is the only economy in the world since COVID that is better off than where it was pre-COVID. And corporate profits are at all-time highs. That's only in the United States. There's no other place in the world like that. So if we could get a little bit of a USA, just kidding. But there's a little bit of that right now. We are doing exceptionally well. Now, the US economy, we are working as hard as we ever had. There's more jobs right now in number of hours worked than ever before in the country's history. So we're all working hard, and it's showing up in the corporate profits, it's showing up in the economy, and it's showing up in the stock market. That's what's driving it. So one of the most undercovered stories in the news today, in our view, is that the Midwest is carrying the US economy, which is the strongest economy in the world. It's not the West Coast, it's not Boston, it's the Midwest. And there is an onshoring trend that is taking market share from the rest of the world. So what we're actually looking at is a map, and each one of these dots is a new manufacturing plant. We are bringing high-end, technology-driven manufacturing to the United States. This is robotics, automation. It's integrating AI. The other thing it has, energy. If you wanted to open a manufacturing plant in Europe right now that you're going to do in Ohio, let's say the Intel plant here, if you wanted to do that in Europe, the energy cost would be 5 times more expensive. We're energy independent. We've got technology and industrial capabilities. This is driving us growing faster than anywhere else in the world. And these are places, these manufacturing, this was in China, this was in other parts of the world. And after COVID, we came back and we said, look, we're gonna do this. We're gonna do it the right way with technology, robotics, automation. We're gonna do it efficiently. And that's what's being built out. So all these dots, again, they're either manufacturing of semiconductors, electric vehicles. Ohio is booming. We see it. Some of our best portfolio managers are actually invested in Ohio companies and in Indiana companies. And we're sitting here saying they're great quality companies. They're trading at cheap valuations, and people aren't looking at this. I mean, AI is obviously a huge earnings driver, but we think this is actually one of the most undercovered stories, and we're investing in it. So this is one of our biggest overweights is actually Midwest mid-cap industrial companies. So I love coming to the Midwest and telling you all about it, because I think it's one of the best stories out there and one that we're really actually excited about. And this is driving the economy as much as anything. If you want to know where the best real estate markets are in this country, it's actually by these dots. Did you see there's no dots over in California? California's real estate market's actually really struggling. The Midwest real estate market, I was just talking to some of you about the real estate market here, and houses are selling. Housing prices are up. That's not necessarily all of the country right now. So again, this is one of the powerhouses, if you will, economically speaking in the country. All right, I said we were going to talk about the elections. So let's do it. So I've been doing this for 10 years now. It feels like a lifetime, especially as it relates to politics and investing. So I was doing this in 2016, and I went to a lunch where they had all the smartest political strategists out there. And every single one of them told me Hillary Clinton is going to win, and there's no doubt about it. And if Trump wins, the market's going to tank. Not one of those people still have a job, okay? So they got the politics wrong, they got who wins wrong, and then they got the market response wrong. So one of the things I think about for politics is, one, it's really hard to decide who's going to win. It's always going to be unpredictable. Politics are just unpredictable. The other piece of the question is, though, what does well in the market, even if you knew in advance who's going to win, what the market would do. So what we said was, okay, what is the best performing things under the Biden administration? Anyone want to guess? It's kind of small up here, so I don't think you can see it. Energy. So I'm not talking alternative energy. I'm talking drill, baby, drill. Let's go fossil fuel energy under the Biden administration. I would have never thought that in a million years. And it wasn't because of Biden. Actually, it was in spite of Biden in some instances. There was letters being written. The energy sector produced oil while OPEC stepped back. While Saudi Arabia said, let's actually squeeze them here and cut back production and get prices up as the Russia-Ukraine war is going on, the United States filled that void and increased production. We did it when oil prices were really low. We made a huge investment and we pumped out more energy, and energy stocks have come back from this. Up in the top 10, industrial companies. And the S&P overall did about 16% annualized over the Biden administration. But this is not at all what you would think under the Biden administration what would do well. Why is that? It's all about profits. It's all about the valuations of the businesses when he took over and the profits the private sector does. It doesn't come back down to who's in the White House. Under the Trump presidency, let's say here, number 6 on the list, Chinese stocks. Do you remember back then hearing about the tariffs, hearing about the trade war? Chinese stocks did well. I would have not thought that for a million years. My point here is just that politics and investing don't go together. And you're lucky, I mean, talking to Ben about this beforehand, he has been spot on with this and really kept his investment philosophy out of going into politics. I think really that is one of the more important things in investing is to not let politics drive your investments. How are we doing so far? All right. So today was a big day. I don't know if you all celebrated. Do you know what happened today? The Federal Reserve cut rates, right? Bobby, my partner over here in crime, was saying that he couldn't sleep last night. It was so exciting. Yeah, I couldn't sleep because of my kids. But, it is a big deal. I mean, this is the first, they had raised rates a lot, and now they're starting to cut rates, right? So this is a big deal. And this is just actually looking back at the Fed funds rate. So that's what when they talk about rates, that's the blue line here. And then the 10-year Treasury yield is in green. And rates are high. We're getting income now. We're able to get income. Now, I've been doing it, again, for 10 years. The first 7, 8 years of doing this job, if I said, hey, let's generate income, let's find income for you, I'd go to the bond market and it was like, hey, I could do 2%. What do you think? And people would be like, doesn't sound great. In bank accounts, we're earning nothing. I mean, it was really hard in the bond market and fixed income to get income. Now yields are almost 4 or 5%. We are getting some really nice income, but this blue line, the Fed funds rate, and what you get in your bank account, that yield is likely coming down. And frankly, it's going to come down pretty fast. We believe that it could come down to about 1% in the next 2 years. That's why you got to think about investing in the bond market, thinking about getting that yield, making sure you have it. And it sounds like, again, Feldmeyer Group has just increased the duration of portfolios, looking at the bond market for you to take advantage of the yields while you still have them. But one of the things, again, when these interest rates go down, that income you get out of a savings account probably won't be there, and not to nearly the same magnitude. So this is typical. This is what cycles do. Interest rates go up, interest rates come down. You want to buy them. You want to buy more income when the rates are actually higher. So I want to just kind of finish up here on cash. So I have actually a Bank of America account, and they're so nice. So I actually earned interest on my Bank of America account, and before it was 0.01%. Now it's 0.1%. So the Fed raised rates 5.5%. They gave me 0.1%. Isn't it? I mean, look at them. Just really good people at Bank of America. Nothing against them, really. But the way that this works is, though, they get the 5.5. They pay their clients basically nothing, and they make the profit in between. And you have to be very thoughtful about every dollar right now, because there's some bank accounts or even if you have any cash, it could be earning basically nothing, while another cash vehicle could be earning almost 4 or 5%. Again, working with a financial advisor, the great team that you work with, they know about all this stuff. They know where the right place to put the money is. You're still very liquid, but every dollar counts, every percent counts. And so there is a record amount of cash on the sidelines right now. There is $6 trillion of money markets sitting on the sidelines. There's $15 trillion sitting in bank accounts. There's $5 trillion on corporate balance sheets. There is a ton of cash. And that cash is going to be put to work. It's going to be invested. It's going to be put somewhere. And that is likely going to be another part of asset prices, of investing, that's going to drive investments from here. Overall, what we're seeing is investors are pretty cautious. They're actually pretty disciplined right now. We're not seeing euphoria. I'm not seeing people say, I want to get in the stock market. It's not like the tech bubble like that. Actually, we see a lot of people that are sitting in cash. And frankly, we believe that's going to be put to work in the next couple of years, and that could be very helpful for our investments. We just got to be, luckily you're thinking about that now, not waiting for when all the cash is already put to work and it's already in the markets. Those are my prepared remarks. So the question is on the deficit. And basically, is it sustainable? Likely not. And then it's also, how does this all go with the inflation as of late and housing prices being elevated and everything else? So I've got a couple thoughts.
Please go ahead.
Okay. So I've studied economics around the world for a long time. I mean, history-wise, part of my fun time is reading history books on economics. That's how nerdy I really get on this.
We gotta hang out together.
Right? So, long story short, every time that this has happened, and this has happened over time, the only way out of it is growing your economy. So the thought is, why don't we just raise taxes, right? No, it doesn't work that way. If you raise taxes, all the money leaves, they go to somewhere else. They go to somewhere with a lower tax rate. And also that then just crushes your economy, and then people don't grow, they don't invest as much because taxes are high. So it actually has a counterintuitive implication. What you need to do is grow, and you need to take market share. You need to get, if everybody grows, right? So if the economy grows, you get a raise. Then you get a raise, then you get higher taxes. So we've got to grow, and it's not easy. Frankly, again, we're taking market share from other parts of the world. That's bringing it here. That's increasing taxes. Now, we are likely going to eventually slow down our government spending. I know, I got to knock on wood a little bit, famous last words a little bit, but hey, we just came from so I'm a little bit of a statistics person, but what just happened in the last 5 years hadn't happened in hundreds of years. We have never shut down a global economy before. It cost us trillions of dollars to do that, but it probably won't happen again. We're probably not going to give out money to just not work. So in the next 5-10 years, what's probably going to happen if we do get an economic slowdown or something like that, the Federal Reserve is going to cut rates aggressively, but we're probably not going to get a bunch of checks. We're probably not going to get a ton of stimulus. So the Federal Reserve cuts rates. What does that do? It makes our debt a lot more manageable in terms of interest payments, at least. It lowers the interest rate. And if we don't give away a ton of stimulus again, like we did last time, it actually brings down inflation. Because inflation this time, all that, the housing prices getting jumped up and all your food, your everything, the cost going up. What that all was, sorry, this is going again, was really due to all that stimulus. So I guess what I'm trying to say is don't try to over extrapolate what just happened is normal. This was not normal. And we're growing faster than any other part of the world. Everyone spent a ton of money, Japan, China, Europe, but we're growing our way out of it. I'm not going to say that's going to be an easy solution, but if I was to bet on anywhere in the world to get better at that, to start chipping away at that, I'd put it on the U.S. because we've got the best growth. We've got, again, like we're going to have lower interest rates. That's going to help the borrowing costs. And I don't think we're going to have as bad of inflation because I don't think we're going to spend like that again.
I agree. The question is, there's a math. There's got to be a solution on it. Washington, D.C. isn't going to come up with a solution on things. Okay, they're just not. It's about the democracy and all the things that we could debate for forever, but there is no way that we're just going to tell folks who have been receiving some sort of a benefit, you're not going to get that anymore, and we're going to raise your taxes over here, and we're going to do all this so we can balance this budget and get all this debt paid off. We're just going to be in debt. And the question is just how much and can we manage it? The interest savings alone on lower interest rates is a significant number. Absolutely, it's a significant number. And I agree with you, slowing the economy down will not help, right? We need to take advantage of things while they're up. Would we all, everybody in this room, agree that some fiscal control out of Washington, D.C. would be great? Nobody's going to argue with us there. Yeah, just clapping in the background. Yes, of course we would. Okay, so how do we express our thoughts? What do you do in early November? Vote. Yeah, know what's going on. Okay, know your candidates, know your beliefs, know what it is that you should do, and do the thing that we as good American citizens should do and vote, right? That's how our system works. What else? Who else got a question? Yes, Greg. The question basically is if we, for the industries that are making it right now because of government giving them money, what happens when we start cutting back on these programs and there is no government money? And my answer is, if you're going to fail, you have to fail. Okay? Interesting at this stage of the game. The bond market is smarter than the stock market. Those of you who have heard me describe the two, I describe the stock market as a colt that's let out to pasture on a cold morning. Stand back. It could go anywhere at any point in time. Example, today. The Federal Reserve cuts interest rates by 50 basis points. The market has a nice move up a couple of 100 points. Where did it finish? Down. Lower for the day. What? That's a colt that's just flying around all over the place. But what does that colt do by the end of the day? Find its way home. It's just got a big standard deviation, right? Mathematically, it's jumping around all over the place. The bond market, however, is your old steady mare. The bond market is just there. It sees what's going to happen ahead of time. Bonds, corporate bonds, have a rating. AAA, AA, single A, triple B, single B. Everybody's, right, heard us explain all this stuff before. There are more companies getting their credit upgraded at this stage of the game than ever before. How's that? Why? Because if you made it through COVID, you're here to stay. And you're profitable, right? Guys, you know what a great sign that is when the bond market is saying, we're in great shape. As a matter of fact, the companies that we had some questions about, we don't have as many questions about them at this stage of the game. Defaults on double Bs are at like 0. I actually just said that, right? It's a good time. This is a good time to be an investor. There's good times and bad times to be an investor. Actually, it's good times and great times. There really are no bad times, right? This is just a time. This is a good time to be invested because we're not thinking about what the market did by the close of business today. We know the trajectory on things. We know the trajectory of the economy. We know that it's going to keep moving forward. Did you have anything else you want to share?
Yeah, I mean, I guess, so I did cover energy as an analyst at one point, and I do think that in the energy sector, just like all the other sectors, technology and productivity and just what is, like, so fracking, you know, the amount of ability we've gotten from natural gas and fracking is just changed the game. Like, we could be outsourcing and supplying the world with natural gas, cheap natural gas. And these energy companies are coming up with new ways constantly to find oil reserves, refine it better. Every company is doing it better, smarter, faster. That is what America's about. And again, I mean, energy stocks have done pretty well. They've come back, but they're more dividend payers now. They're kind of sitting there. The technology sector is growing, healthcare is growing, communication services is growing. We've got a lot, and then it's not necessarily the government there. It is we're taking market share. Even in the oil example, the energy example, we're taking that from OPEC. Saudi Arabia came out, they came public with an energy company, and we're already taking market share from them. Little old us. So I think that's what I'm thrilled about more so. I mean, the government part where it's like, hey, they're supporting our businesses, it's a start. I think that onshoring's legit because the technology, because the energy resources, because we've got all this industrial know-how. So to me, that makes me excited about it, more so than the government piece. So money market yields are coming down. How do you think about deploying those assets as those yields come down? So Ben was just talking about all these corporate bonds, either BB or even higher, AAA, AA. I mean, the government's not even AAA anymore. So, but there's corporations that are AAA. And these yields are about 5%. Another part of the market we have is, it's called mortgages or agency. It's called agency mortgages. So one of the parts we like right now is if you locked in a mortgage rate 2 years ago-ish, or 3 years ago when they were low, let's say you got 2.5%, 3%. So you're probably never moving from your house ever again.
Not if I have anything to say about it.
So these companies, all these people, they locked them in. They're not going to prepay. They're not going to pay off their mortgage. They're going to keep their mortgage, and they're in great financial shape because they have to pay these low mortgages. Well, they get sold to the market, and they originate at a bank. Then they go sold to the market. Those bonds sold off in 2022, and we're yielding like 5 to 6%. They're AAA quality, great bonds. Now they're like 4.5%. But that's another part of the market we like too. So you're getting pockets of opportunity either in the corporate bond market, higher quality, or mortgages for people that have really good pretty good financial situations. That can get you about 4 to 5% in yield, and that can lock it in for the next 5 to 7 years. Those are some of the opportunities we see.
And that would be an idea of just buy individual bonds and hold them.
Yeah.
Yeah, just buy and hold.
Yeah, it's just, boring is a great investment strategy right now. And I'm really happy with that.
There's something else just about the interest rates. Let's talk about a little bit of math here real quick, okay? I'm sorry. So when we're trying to slow the economy down and the Federal Reserve starts raising interest rates, it's like pulling back the reins on a locomotive. It's almost impossible to get it stopped. So they raise and they raise and they raise quickly, and they've raised them a lot, okay? Now think about the math when the economy starts to slow and those reins are pulled back so hard. As soon as we start to slow, it's going to slow down pretty fast, isn't it? Because mathematically, as soon as we start to slow, those higher rates are going to have a bigger and bigger and bigger effect. So it's believable that as the economy does start showing signs of weakness, they're going to move bigger numbers and possibly faster. The big discussion 24 hours ago was 25 basis points or 50. What's the Fed going to do? Across the board, everybody said history is 25, plan on 25. Do you think they'll have the guts to make it 50? And what did they do? They made it 50, which confirms they're concerned about things too. Now, inflation is not at 2%. I don't think that's really a realistic goal. By the way, the long-term average 75-year history is 2.3, 2.7, somewhere around there. It's not 2. 2 is just too low. The concern is the job market is showing some signs in some areas of slowing down some. And remember, the Federal Reserve has a dual mandate. What does that mean? They not only have to keep inflation low, they also have to keep everybody working. Well, that's simple enough. Here, let me just wave my magic wand and we'll make that happen. The concern about a soft landing, are they going to actually be able to pull this off? It looks like they're in good shape. That's all the signs are. They're going to make this happen. They're going to get it done. Okay, so we're bullish at this stage of the game, cautiously bullish, right? Some fertilizer on a plant's a good idea, but just dumping the whole bag on it, that's a bad idea. right? We need to have the correct allocation. We need to be logical about what we're doing. The mathematics that we're using and the research that we're doing, a lot of you in the room own our stock model, and we own a company called Badger Meter. You know what they do? They make meters, like they go on a pipeline. That may be like the most boring business that there is on the planet, but we're up huge on it. Why? Because they make a good profit, and have you ever seen a pipeline that didn't have a meter on it? And guess what the power companies are going to tell you? Every so often they have to do what? Replace your meter. Yeah, we need to upgrade your meter. We're going to need it. There's so many places that we can go out there to make money. Okay? One of the other things that we've been asked for is some specific stuff on tech, specifically AI, artificial intelligence stuff. We've had a number of folks say, can you get us an expert on that? And I brought it up at the staff meeting this week, and I was told, can we get past Wednesday first? And I said, yes, I will cooperate on that. But next week, we're going to be on the phone with our vendors saying, who do we have as another Matt, right? But we're not going to do something like this. We're going to get it to you faster. We're going to offer it up as a Zoom. Okay, so if you're interested and you want to tune in, we'll let you know. We'll give you plenty of warning on things, but we're listening. And if you have questions, we want to get it to you. Any other questions? If not, I'm going to have some final comments to close up. Cool? All right, Matt, thank you.
Thank you.
A pleasure. Everyone, let's hear it for Matt. Hey, thanks for coming out. Great time tonight. Very productive. As we reach the conclusion tonight, I want to share with you that over the last 30 years, I've developed tools to help families get their finances organized. We've helped them get their legal documents organized. We've helped them get their ownerships of everything put together correctly, their beneficiaries listed correctly. We've been there for their life decisions about things that are changing in their life, whether it's a job offer, the opportunity to retire, the loss of a spouse, the birth of a baby, all these different things. And we've been there to help some families settle an estate. And while we've done all of this, we've discovered that we're missing something still. We realized that we need another tool. We needed something that will help the family members know who to call, where to find things, how it works, that the trash gets carried out on Wednesday. Wes, the trash gets carried out tonight. Okay? So we need a set of instructions for the family. So we designed the Legacy Planner. The Legacy Planner is a culmination of several months worth of work, and we will be introducing this to you the next time we see you in person. Is this a requirement? No. Is it a really, really good idea to take a look through it and think about, does anybody other than me know that I keep the keys to the boat in my sock drawer? Why would I use that as an example? Because my dad kept the keys to the boat in his sock drawer. And when he passed away, my sister said, does anybody even know where the keys to the boat are? And I said, yeah, they're in Dad's sock drawer. And she looked at me and went, you've got to be kidding me. How do you know that? And I said, because there's things that I know about helping Mom and Dad. We had a client pass away. He was the only one that knew the password to get into the family computer. That's not good, right? How to get into their phones, how to get into anything. So we're working on, and we've created, and I got to tell you guys, Gretchen, this is not a financial planning tool. This is an organization tool. And if you think tonight was organized and Gretchen did it, this is a lot of Gretchen's work that she put this together. We worked together on this. We're very proud of it. We're looking forward to rolling it out because it's a dynamite program for everybody to be able to use. Okay, so last thing, let's go back to our packets. On the right-hand side, you should have a feedback form. If you are a guest tonight and you find the things that we've shared with you to be of interest and you'd like to talk about it, talk to us in person, put your information on the feedback form and put it into the basket up here on the table. Becky, if you'll make sure we get those collected. Becky will collect those. That would be great. We'll give you a call. We'll get some time scheduled for us to talk. If you're an existing client, give us some feedback on things. And if there's something that's a topic that you would really like to know more about, put it on there and we will do our best to get you the information that you're looking for. Overall, everybody, thank you. Thank you for your business. Thank you for your trust. Thank you for your friendship. And thank you for coming out tonight. Have a nice evening.